You spot a stock breaking out. You hit the buy button, and almost immediately the price turns around and drops like a stone. You hold on, hoping it bounces back. But hope is not a strategy. You are trapped in a losing position simply because you did not define an exact exit plan before making the trade. To fix this, you need a strict 3-step checklist. We are going to map out exactly where to enter, precisely where to place a technical stop loss, and mathematically how many shares to buy. Pull up your charting software. Before we do anything else, enable your 21-day moving average, your 50-day moving average, and add the average true range, or ATR, indicator. By building this structure around every single trade, you ensure that even when a setup fails, the loss stays within the precise boundaries you defined before the trade ever began. Step 1. Stop chasing stocks that have already stretched far above their historical price averages. Instead, wait. Let the stock cool off and pull back to key support levels, specifically those 21-day and 50-day moving average lines you just turned on. Look at this NASDAQ chart. The market uses the 50-day moving average as a strict floor, finding support and bouncing off it. Individual stocks act the exact same way. Watch Dell pull back, find immediate support at the 21-day moving average, and hold steady. Buying at these exact support levels gives you a defined physical zone on the chart to test your trade, rather than guessing at a random price in the middle of a rally. This highlights asymmetric risk. Notice the tiny red box below our entry. That is your minimal risk if the moving average fails. Now look at the massive green box extending above it. That represents the potential return if the stock rallies back to previous highs. Waiting for these exact support levels mathematically tips the scales. You keep the distance between your entry and your technical exit as tight as possible, while leaving the upside wide open. Step 2 requires identifying a hard stop loss. This is the exact price where the thesis of your trade is definitively proven wrong. Do not set this stop loss based on an arbitrary percentage drop, like 5 or 8%. Percentages ignore the actual structural levels where buyers and sellers are interacting. Instead, look for a specific technical structure to anchor against, like an upside reversal or an outside day. Look at this upside reversal candlestick. It undercuts the previous day's low, shaking out weak holders before finishing at the top. Because buyers stepped in heavily at this exact low, we draw a hard line directly beneath the lowest wick. This becomes your uncle point. If the price drops even one single penny below that red dotted line, the buyers have failed, support is gone, and you must exit instantly. Tying your stop loss to a structural low point removes emotional hesitation. You aren't deciding whether to sell based on how you feel. The chart makes the decision for you. With your entry and exit locked in, Step 3 determines how many shares you should actually buy. This brings us to the average true range, or ATR. This indicator measures a stock's daily inherent wildness, literally how much it typically moves in a single trading session. If you apply a standard, full-sized portfolio allocation to a highly volatile stock, the normal daily swings will quickly put you in a deep financial hole. Take a look at this chart for NBIS. The ATR metric up top reads 11%. That means these massive, violent daily price swings you see in the peaks and valleys are completely normal behavior for this specific asset. If you are holding your normal, full-size position, an 11% swing against you will almost certainly force you to panic sell, shaking you out before the stock has a chance to work. To survive this, you adjust the math. Because the price movement is so wide, you cut your initial dollar allocation in half, keeping the total dollar risk exactly the same. Intentionally shrinking your position size on wild stocks provides the psychological and financial cushion needed to ride out normal turbulence without hitting the panic button. Let's review the final setup on this graphic. You enter exactly at the moving average line, you draw a hard stop-loss line perfectly beneath the reversal low, and you scale your position size to match the stock's volatility. You have removed the guesswork. You now rely on strict technical levels and a consistent position sizing framework to protect your capital before you press buy. Now it is time to build this structure into your own trading routine. Open up your charting software and pull up your most volatile holding. Find its absolute structural uncle point using the moving averages and reversal lows we covered today, and leave that exact dollar amount in the comments below.